Event and kind of the theme here today is trends that we're watching for in 2022. So one thing that really stands out to me as far as a trend to watch for, and we're already into the trend, is looking for greater market uncertainty and much greater market volatility. So that's kind of what I'll be talking about here today, and the ways to approach this and take advantage of it. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. Now, 2022 will be a year of greater market uncertainty and greater volatility due to the higher inflationary environment that the economy has now entered into. So the Fed has, fallen behind the curve and is now being forced to really put the brakes on to the economy. And this typically, over history leads to the Fed taking liquidity out of the markets to slow spending in order to halt the rising inflation. So this is what they're going to do. They're going to take away the old punch bowl. Now, how is this done and what are the consequences? Well, the thing that they'll do is that they're going to increase interest rates, supposedly 4 rate hikes this year. But the other thing they'll do is reduce or put a reduction into their federal balance sheet, that they've been buying mortgage-backed guarantees and bonds and stuff, securities, just giving liquidity to the market for over the last 3 to 4 to 5, 10 years. So they'll take that away. So that's going to provide less liquidity to the market. Now, what are the consequences? Well, increased market uncertainty for sure, increased market volatility that goes with that uncertainty, and the increased odds of a recession and the increased odds of a bear market. So these are things that we have to, ponder and wonder and worry about, and that creates market uncertainty and volatility. So if you look at this chart here, this is from the Federal Reserve, and to the left is the interest rates, the level that the rates got to, which is unbelievable, and down below are the years. So if you look at this chart here, you can see that back in 1980 peak, interest rates prime rate was up over 20%. Now these are long-term, macro kind of trends. So you can see that this bull market on the bonds started back here in about 1976 and, went for 4 years, right? So these are trends that can stay in place for quite a long time. Now you can see that we peaked out here and then bonds have been, coming off, which means interest rates go up. But here again, we had bonds moving higher and interest rates. You can see interest rates or bonds moving lower. So interest rates finally starting to move up. Now, there's only, these are the interest rates. So how much further down can interest rates go? Not a lot further. So the Fed can, still do things with the balance sheet, but the interest rates are pretty low. So what is that going to, what is that going to mean to the markets in the near term, or 2022, 2023 for that matter? It pretty much signals that the interest rates are going to probably have more potential upside, and that's going to create a lot more uncertainty and then volatility. Now, in the bear markets between 2000 and 2002, for example, the popular tech-heavy Nasdaq index declined over 72%. It's hard to imagine that going back that far, but that's the fact if you look at the numbers. Now, everyone just loved technology at the time due to the birth of the internet. Does this kind of sound familiar? We're in this area of all kinds of new disruptive technology, so everybody's been chasing things here for the last couple of years as well. Now, only 4 short years later, in the 2000-2009 bear market, the more stable S&P 500 index made up more established companies dropped 55%. So these are things that can happen. We haven't seen this kind of a decline in years, and a lot of people aren't familiar with the impact and how to trade it. So the question is, will history repeat? Well, we don't know for sure, but we can see kind of the signs in the writing on the wall. Now, it's this cloud of the uncertainty that will hang over the markets, I think, throughout 2022. And the market trend then for 2022 will be a heightened level of market uncertainty and volatility. So how can we profit from this trend? How can we take advantage of it? What are the opportunities? Well, for me, the secret to trading profits in 2022 will be using the correct option strategies, and 2 of the best for this high uncertainty, high volatility type markets will be to incorporate butterflies and long condors into your trading plan. So the huge advantage that these strategies have is their unique option framework that's designed to take advantage of time decay, theta, and volatility, the two main option pricing components. So to stack the trading odds way in your favor, and these can be used in any type of market environment, but really makes them great, or our favorite for trading strategy for uncertain markets where you have high volatility. If you just know when to use them and how to use them, then you're going to be set. Now, because they're structured to require only a small amount of your hard-earned capital, your trading returns can be explosive because of the leverage that these things can offer. So it's kind of like, I refer to it kind of like lightning in a bottle. You know, you get that perfect trade and you want to bottle it. Now, when we look at the butterfly and long condors, they're very dynamic and they can be traded for a variety of different reasons with different goals in mind. So in other words, once you learn how to trade the butterfly and the long condor, you're going to be covered for both your offense, your profit, and your defense of a trade. So your goals and protections. So these can really provide your trading portfolio a lot of variation. Now, these two strategies can also work no matter what the markets are doing. They can be an uptrend, a hard downtrend like we're in now, or a sideways price action. They can provide income from stocks that are going nowhere, just kind of churning. They will eliminate the stress of having to be perfect on a stock's direction or overall market, eliminates the time decay expense that you encounter from long decaying options. It's going to help to take the unsettling guesswork out of your trading. And these can be structured for very low cost, low capital at risk type trade setup. So they can offer 10 to 1 or higher return on your risk. But the key thing here is your risk. You can really lower and control risk. So when we're in 2022, like we're in now, with all the uncertainty and the markets, you know, crashing down to these new lows and stuff every day, you want to keep your risks under control. And these are two strategies that can really help you to do that. Now, also the butterflies and long condors can be used for hedging. So when you mess a trade up, which is going to happen, you can use these two strategies as a fast, low cost way to cover your, you know what, pronto. And I've literally found no other hedging strategies that come close to these two over the years that I've been trading options. So by constructing either a butterfly or a long condor around a strike that is under pressure from another core trade that you have on, such as maybe you have credit spread on, or you have a debit spread, it's going to be the best way that you can immediately neutralize, and not only neutralize, but lower your risk. And that's what's really awesome and important. So one of my clients, one of my members, Pam, she said, I wish I'd known how to do this hedging before I lost so much money on credit spreads. And that's so true. So you can literally adjust and hedge a credit spread by converting it either to a butterfly or long condor. Now, the simplicity of it is pretty cool too. So here's an example. Let's say you're long a call debit spread here. So you're long a call, short a call, and this is like going to be a $1,000 wide spread, okay, $10 wide. So you'd be long the 1,010 call here, and then you're short against it the 1,020. So you've got a $1,000 wide spread. Now the great thing here is your cost of the trade is $300. That's your debit paid. All right, so that's the max you could lose. Now your profit will be the difference of 700 would be your maximum profit. Now, what I always try to teach my members and clients, you know, always look to try to never lose the full amount of your trade that you have on. So we could adjust this, and we could adjust this pretty fast by converting it to a butterfly. So all we have to do is, I'll show you here if I can get rid of this drawing tool. All we have to do is sell a credit spread against it. So in this example, we'd be selling a call here, which is the 1020 strike, short that. And then to protect that short call, we're going to buy a call here, the 1030 strike. So we've just put on a credit spread. We brought in $200 credit. So our risk is the difference between the $1,000 and the 200 we brought in. So we have a potential risk here of 800. But the combination of these two trade structures together is what can really help reduce risk and creates what we call the butterfly. Okay, so this is one example of how this can work for you. So now we've got that call credit, the call debit spread here. We added the call credit spread to it, and we just reduced our risk from 300 to 100, and we've got a potential profit theoretically if it goes out right here at expiration, the top of the tent, to make $900 on a risk of 100. So 900% return. So you probably heard people say, hey, I made a 600% or 700, and you're probably thinking they're a liar. But when you use this type of strategy, these are common. And the long condor is one I really favor too, because what we can do with this one is we can widen out the profit zone. So instead of, having a really tight thread the needle to make our max profit with a butterfly, we can widen out this profit zone. And this is what we call a long condor. So we can use either puts or calls to structure this trade. Now, the core concept that makes the butterfly and the long condor dynamic, let's just kind of review that. So the basics of any option trade in general, but especially these types of trade, which have a selling component, comes down to one of the most important option factor is for the butterfly and condor, because they do have a sell side component to it, is understanding how option pricing works and the concept of time decay or theta and the effect that it has on the price of the option. So this is what we're going to take advantage of when we use a butterfly or a long condor. We're going to use and take advantage of the selling component, which is selling time and volatility. So let's take a look. So when we look at selling options, one thing we're doing is we're selling time or theta, and theta is the Greek that tells us how much an option price will go down over time. So which is the rate of time decay of your stock's option. Now, time decay occurs because the extrinsic value or that time value of the option is going to go down as we approaching it closer to expiration. And at expiration, it goes to zero. So it's a decaying asset, and it's like a coupon you might get at a grocery store. At some point, you can't redeem it and it's no longer valid. So in this example, we'll take a look here. XYZ is trading at $45, and we're looking for a little move down to 43. So I always have a target, in mind when I place or set up any trade. And my targets are usually based on Fibonacci moving averages and also then option activity. So a cluster or, kind of alignment of those three things together can give yourself really great targets. So in this example, we're looking for just a move down to $43 right here. So this will be the body of the butterfly. We set the body at the target. So for example, here we buy a 44 put, and that costs $238 or $238. And then at the same time, we're selling the 43 put, we're bringing $1.67. So that alone is like a put debit spread. And then we're going to sell the 43 put, buy the 42 put, and bring in another $1.67 and pay $1.06 here. So the combination of these two together creates, in this situation, a kind of a narrowing butterfly. So we've got our debit costs or trade costs of $238, which is the 44 put, the $1.06, which is the 42 put, and then we brought in a credit of $1.67 twice, times 100 to make it equivalent to an option contract. Remember, one option contract's equivalent to like 100 shares of stock. So in this example, you can see your risk is just $10. That's it. Boom, 10. Now your profit is going to take your difference in your strikes, so 44.43 or 43.42, and that's a dollar-wide strike. So 43 minus 42 less your cost of the trade, 10 cents, equals 90 cents times 100. So your potential theoretical profit, I call it theoretical because you have to go straight out at expiration, right at your body of the butterfly. So in this example, 43. But if that was the case, you'd make $90, and that's on a risk of 10 is a 900% return. So this is where you get those big, kind of returns that you can definitely get with the butterfly. So out of all the option strategies, this option spread strategies, this will give you the highest return. So in this example, you're risking just $1 to make $9. So those are, you take those kind of odds all day long. And especially when we're in a market of uncertainty and high volatility. Now, the next thing is, how do you choose the best butterfly or long condor for your trading goals? So there are a variety of different ones that you can use. But first, though, in my opinion, one major goal for every trader should be to select trades that are going to be based on what's going to provide you the most consistent positive returns with low defined risk and not always the greatest return. So the way I look at trading is I first always look at risk first. Okay. I want to control my risk. That's my number one priority. And then I look at, okay, well, what can I make? What is my potential max return on that risk? So I do a risk reward kind of calculation there. So I make a comparison between different strategies and I pick the one that gives me the best risk reward. Now, in trading, what I've learned over the years is just kind of treat it like a baseball game where you're hitting singles and doubles, and occasionally you get that triple or home run. And that's what you're looking for. But if you hit the singles and doubles consistently, you stay in the game and you build your equity. All right. Now, so one of the best ways then to go after this and achieve it is being aware of the different option strategies that are out there and available to you, understand how they work, and then select the one that's going to be best suited for the market environment you're trading and your specific goals. So for this market environment, of uncertainty and higher volatility, these are two really good go-to strategies. Now, when we look at the butterfly, I kind of call it the butterfly family. There's the long call or put butterfly. There's a broken wing call or put butterfly. Sometimes you might hear it called a skip strike. There's what I call the ninja butterfly. It's an unbalanced ratio butterfly. There's the iron butterfly. And then there's hedging, another big, huge category, which options were originally developed for hedging. So defending your trades using the butterfly. And then there's the long condor, which I call kind of the cousin of this trade. So question, when do you apply a butterfly strategy? I'll show you different examples, but you want to start thinking in the direction of these types of trades when you have real high volatility and market uncertainty, where you're not sure from day to day what's going to happen from market headline. So what do you want to do? You want to keep your risk low. So one of the best ways to keep the lowest risk on an option trade is using either the butterfly or long condor. So let's take a look at a few trade setups here so you can get an idea. Now, the other thing with the butterfly is you can control your risk, and you do that through the wingspan of the butterfly. So think about this. If you're a butterfly collector, and you've got a big or small butterfly net, that's going to be kind of hard to catch that butterfly maybe, right? It's going to be much easier if you've got a really wide net. All right, so we can do the kind of the same concept here with the butterfly. So if we want a big, profit zone and able to catch or a big move, we can widen out the wing of the butterfly real wide. We have a really big zone, but this will increase our cost of the trade, our risk, but it'll also increase the odds of us making money because we've got a wider profit zone. But we have the other option too. If we want to keep it really low risk, we can narrow that butterfly, the wingspan, keeping our risk super, super low. And if we do get it right, we get a huge return on that lowered risk. And these are sometimes what I call a lotto trade. So that's the kind of the core concept, is managing your trade through this wingspan of your butterfly. So this first example is going to be a really narrow wing butterfly. And this is going to be one on SPY. Now, the other great thing with butterflies for directional trading, if you're even hedging or just playing the markets in general, a lot of times it's easier to short the market or go long a market using the ETFs like SPY, QQQ, or the Russell IWM, or the index options, SPX, NDX, RUT. So a lot of times, it's a lot less volatility to use the blend of the ETFs than it is, say, a specific stock. So a lot of times, if we're looking to short the market, primarily because it's been so hard to short the market up until this year, we've usually gone with ETFs or index options because we can, kind of smooth out the volatility a little bit, and they're very, very liquid. So here's an example for a really low risk, narrow spread on the SPY. So for example, in this trade, it was trading here when it was set up, it was trading at 267. So right here. And based on Fibonacci, looking at a target, I was looking at the 618 retracement right in here. So a target of 273. And there's also a lot of option activity. So the complement alignment of option activity and Fibonacci level gave us a good target to 273. So the trade setup was targeting 273. So we did this with a butterfly, and I'll show you how this was structured. So targeting 273 here was the body. Okay, so set the body at 273. So in this example, bought the 272.73. That'd be like a call debit spread, then sold the 272.74, targeting the body of the butterfly 273. The wings are your long options, 72 and 74. So you can see the spread width is just $1 between the two, right? So super low risk, $1 or $100. Cost of this trade was 10 cents or 10 cents debit or $10. So here you go. Maximum potential profit theoretically would be if it went out at expiration at 273, you'd make $90, which would be a return of 900% on that risk of 10. So what if you made $70? So in this example, made $70. That's still a huge return, right? But the thing I look at here and love about it is the risk, only $10. So if you totally messed the trade up and you shorted it and went against you, or a bit long and it went against you, that's your risk. That's why in an uncertain, high volatility, these are great types of strategies to fall back on. So in this example, it made $70 per spread, and that's nothing. That's nothing to sneeze on, right? So do those all day long. So you can see here in the profit tent or profit zone here, going out right there, almost close to that target of 273, but not quite. So this went out with $280 profit on 4 contracts. So that's a risking $40 to make 280, and that's a 700% return. So time decay, volatility collapse, high return on capital, low capital at risk. That's what makes this such a great trend trade or trending strategy for, to me, for 2022. Now, here's another one that we just set up last week on IWM. Now, this is a wide wing put butterfly, and this is an example of this one. So this was one that we did with, I've got a trade alert system that, texts out these types of trades. So you don't have to do really anything. I'll just tell you the trade, and if you want to take it, you can take it. But this is doing a IWM butterfly, a put spread butterfly, which is, and this one was structured for a real wide wing butterfly, $1,000 wide. So wanted a big wide net for this one, and to capture any profit in this sell-off. All right, so we made this one real wide, $1,000 wide, and I'll go through this. I'll step you through this one right now. Okay, but why use this again? Hard to short the market. It used to be hard to short. Now this year, I think it's going to be a lot easier to short. That's the trend. It's going to be easier to sell the rallies. That's going to be the change in the market trend. These are structured for defined low risk. Okay, I look at risk first. I want my risk low. Used to trade high volatility markets. That's what we're in now, right? The VIX just shot up to, a massive high here. And let me show you where that is. VIX looking pretty steamy here. If I can find my VIX chart. 1 second here. Here we go. So that's what we've got here. Super high volatility, right? Now we've got, typically though, while I'm here, this won't stay up very long. So be careful in this market. We're going to probably start seeing a little bit of a possible short-term bottoming. So keep an eye on that VIX and just the market in general. But this is what we're dealing with. And then that's why these are great structures. The other thing is we can set these up for a one-day trade, or we can set it up, going out 2 weeks. We'll have what we call positive theta, no time decay. So if we sit on this thing, if the market turns sideways, we're not going to lose on this trade from time decay. Returns, you get 2 to 1, 10 to 1, or even higher in some situations. So here's the trade setup that that I sent out to the alert members just last week. So this was last Friday, I guess, or Thursday, for 20th. And yeah, this was Thursday. So this was just what it looks like. Okay, so the alert, so new IWM short, it was at that time trading at 206.65. Right now it's trading at 195. So it was sending out the alert. So buy a butterfly, the 28 Jan, 205, 195, 185. So wide wing spread between $10 wide between each strike. and do this around $1.80. So that'd be $180 maximum risk for a $10 wide spread. So I always put in targets, first target 201 and then 195, which we hit today. Now today, sent out alert to take some profits, okay? Profit IWM trading at 194, hit profit target 2 at 195. If long, this butterfly, at that point in time was up $121 per spread on your risk of 177. So super low risk trade, great return, and a great way to play this environment. So here's what it looked like. So we took the short, this was a weekly chart, but this was when what we call a volatility compression squeeze on the weekly. And this has been a consolidation pattern going on for a whole year. Okay, so this has potential for much more downside. Now, it'll probably reverse back up and, for a short covering rally and then sell it again. But this started back in January of 2020. And you can see it went sideways, the Russell all of 2021, and finally just last week broke to the downside. So we're into the first support zone here at 190-ish, 195, and then we've got more. Next support will be at 180 and then down to 174 or 75. So this one we'll be looking to do again, but right now we're in a profit right here. If it rebounds back up and fails, we'll look to short again. And I think there's definitely probably more downside for this because this is a long-term squeeze that has been going on for a year, and typically these will last, in this situation, 3 to 4 to 5 weeks potential, more movement to the downside. Okay, so here's the trade. So we set that up. So my momentum indicators gave us a directional trade to sell. So we set this trade up. Now look at the risk. Okay, always look at the risk first. Maximum risk on this trade, $177 per spread, $1.77 debit. So this was going long. We were targeting 195, and we bought the 205 put. It was trading at 206.65 when we set it up. Sold the 195, then sold the 195, 185. Now, if you had just done the QQQ shares, for a short, well, and you hit 195, well, you made $11.65 per share. That's a 5.6% return, but big deal, right? In this trade, your potential profit, if it goes out at 195, hits your target at expiration, you'd make $823 per spread. So on one spread, your risk is 177. So that's a 465% return, or a risk $1 to make $465 versus 560. So, I will never, ever do anything with the shares because this is what you're giving up. I mean, it's just a no brainer. There's always say there's no such thing as a no brainer, but this is pretty close to it. And you've defined your risk. Your risk is only $177 in this situation. Okay. So that's an example of what that looks like. Now, where did this go out? Well, today it still has potential for huge profit, but today we started taking profit. And it was trading right here at 194.81. So this was up $130 per spread, our risk being $1.77 or 177. So this is currently up 73% and just basically 2 days versus if you'd done just the ETF, it's 3.9% gain. Okay, again, time decay, volatility collapse, high return on capital. Now you can see all this black area in here. That's what's still left of profit. This has huge potential for profit. There's a potential that this can make over $800 profit. And that's because this is all the time value component, okay, and also implied volatility. So the butterfly and the condor, we're selling time and volatility, and this big black area is what's left of that time component and volatility component. So if it was just to stay here for the rest of the week until this Friday, which is the expiration, and it was up here, this will be up over $800. But we did this, we're not looking to make 800, we're looking just to participate in this market move to the downside on very low risk. And this is one way to do it. And we're up already 73% on this trade. So, a nice trade setup. And this is where we currently are. I'll show you right now the trade if you want to just kind of get a better idea for it. pull the chart up here. So here we are currently, you can see how it's starting to bounce back a little bit. Came down to this key support here, 190-ish, and we're bouncing back a little bit. So this trade, you know, you want to try to stay with it, but we have low, what you do now is you put a break even stop in and just stay with it, because this, you can see where it's trading right here. At the end of this week, if it's trading up here, this black area is going to be stripped out and it's going to be headed towards the till. That's the risk profile or the profit P&L at expiration. So that would be over $800 profit if it was here this coming Friday, trading at 195. And it's currently trading, see, it's already moved back up to 200. So we've got a really nice profit zone in here. But that's the beauty of it. If you're wrong, you're not getting hurt too bad from your trade decision. All right, so that's why they're such a great trade strategy. Now, the other part is hedging. So another, you know, just a whole nother category here. And this is what I call, or one of my members termed, opportunistic hedge trading management. So this is using in this example, a put debit spread that we adjusted and turned into a free trade. So we had zero risk after we did this adjustment, and we did the adjustment to a put debit spread to a what's called a put condor. All right, so here's how it works. So again, structured for defined risk. We can really, you know, really home in on our risk. Great for hedging. Used for directional swing trades, trade that might last a day to 2 or 3 weeks. Big fat profit zone. Trading high volatility markets, perfect for that. Trade duration 1 to 3 weeks. Positive data, no time decay. Return on capital on the long condors are 2 to 1 or up to 4 to 1. So in this example, we went short, and we did this initially with a put debit spread. So it's trading right here. Started off with a put debit spread, and then we adjusted the put debit spread to the long put condor. All right, so this is how that works. So it was trading at 365 when we went short right here. Okay. Then we were targeting down here to this area here. And like, you know, playing cards, poker, or chess, always thinking 1 or 2 steps ahead. So we were thinking, okay, if it gets down here to our target zone, let's see if we can sell an option spread against it to recoup or recover the cost of the put debit spread. And that is how we can turn it into potentially free trade. So trade 1, when it was trading at initially at 365, trade 1 was the put debit spread. So long the 6 October 364 put, short the 360, okay, $4 wide spread. Now the cost of this put debit spread was $1.21 or 121 bucks. That's max risk, not bad. Max potential profit, spread width 400 minus your cost of the trade. So potential, you know, if this was to close below the spreads at expiration, you'd make $279 or 230% return. So risking $1 to make 2.5 or 2.3. So not bad, but we can improve this. We're always looking to improve the trade by either improving our theta, you know, decay, get it more positive theta, or lowering our capital. So in this trade, when it traded down to 354, kind of our initial target, we had the opportunity. So on the first, it traded down to 354. At that point, we were able to sell the 354 put, buy the 350, $4 wide spread, bull put credit spread, and we brought in $1.41 or $141. Okay. So we brought in 141. Now the first trade that put debit spread, we had a cost of $1.21. So we just recovered that cost and actually improved and turned it into credit. So trade 1, 364.60 put debit spread, $1.21. Trade 2, the adjustment, 354.50, 350, $1.41. So now we have zero risk, right? We actually have a credit. So even if this thing went straight down or straight up, we're still going to make $20 regardless. Now, if it goes out anywhere in between these two spreads here, we make a huge amount of profit. So on the first, it was traded through 354. So at that point in time, it was up 152 on the spread plus the credit of 20. So it was up $172 on zero risk. And then at expiration, just sitting on it, it expired right here in between the two spreads at 359. So it was a max profit of 420 on zero risk. So this is the home run. So you chip away singles, singles, doubles, doubles, and then finally, occasionally, every now and then, you'll get the home run, and that'll really boost your equity curve. While in the meantime, you're playing singles and doubles, keeping it, protected. So that's the hedging aspect of it. So you can see here again, the max profit on this was adjusted to 420, and max loss, there's no loss because it's done for a credit now here of $20. So that is the beauty of these types of structure. We can do a lot of different things, with these two types of strategies. So I just wanted to go over this with you today to show you how you can trade this current trend of an uncertainty and high volatility. And if you'd like to learn more on how to master these, high reward, low risk option strategies that can work in any market environment, but especially right now is what you want to be using these two strategies for sure, then I've got a great package for you here today if you'd like to join in and take advantage of it. So with this trade package here today, you're gonna get my butterfly and long condor option masters course and the bonuses that come with it. So this course package here is, let me give you the link here. It's a special, here it is. One second. You should be able to click on this link, or you can copy and paste it in. So it's powercycletrading.com/GIVE. So with this package, I've got you a nice 6 bonus package, value of over 1,000. But for everybody here today, if you'd like to jump on this offer, it's 197. Now, what you're going to get is you're going to get this course. It turned out to be a 7-hour course. It was done live, but then I recorded it. So I recorded it live, broke it down into modules like a chapter of book. So it's a 7+ hour course, just 100% on the butterfly long condor option strategies. So these are broken down in modules of 30 minutes or less, plus you'll get the full PowerPoint. Now you'll get this and keep this as long as you want it, and you'll have a login to get into your vault for your course here. Now, in addition to this, you're going to get my recorded course on start trading options today. This course value is $197. So this is an option trading course more kind of geared towards beginners. So I thought that might be a good complement for anybody here today. This is kind of getting into the option side of things. You can start out with this, but the butterfly is something you would definitely want to learn. Plus, you'll get a month trial membership to my Paracycle Trading Club, and I'll show you the benefits there in just a minute or so. Now, if you stay with the club, it's $97 a month, or you can get an annual membership. But this trading club, you can start this anytime you want. So you don't have to start it today. You can automatically start it a week, whatever day you want. So you could take the course first, then start the club, and then you have access to my trading room and our Q&As. So I want you to have that for, kind of support when you need questions asked. So that will be a 30-day trial membership to my trading club. Then we'll do a live follow-up support Q&A, which will also be recorded. This will be a week or 2 weeks out. We'll send you a link to that. And then as an additional bonus, you're going to get, what I call how the pros use the Greeks. It's the option guide to the Greeks, okay? So this will tell you about theta, gamma, delta, all the Greeks. And so nice, videos and handouts and stuff just focused on the Greeks. Then an additional bonus is my option strategy manifesto, 15 different option strategies to tell you like what is a back ratio spread, how's that used, a straddle, a strangle. And then for your desktop, print out the Greek power tool guide. So this is something you can print out with the Greeks on it. So you can just have it at your fingertips. So all this, value of over $1,000 for $197. And again, here's the link. Let me put it in one more time. And again, you can start the Trade Club membership whenever you'd like. Let's see. Did I have that? Yeah. All right. So that's that. Hold on. Let me get the link here one more time. Okay, there it is. All right, so let's go through what you're going to get here. So first off, the course is 7+ hour recorded course, easy to follow, 30-minute modules or less. So like a chapter of book, every part of the course is in a module. So along with the videos, you're going to get the PowerPoint of the course. My courses are very detailed. So it's a 456-page training manual PowerPoint of the entire course. So step-by-step blueprint course on how to use the butterfly long condor for income, high reward, low risk directional trades, non-directional trades, and hedging. All right. Now, part one is we're going to go through and you're going to learn the Greeks that are vital to trading a butterfly and long condor. So, how do those work? The Greeks, the different delta and things like that. How's that going to help you trade these trades? So just a review of those concepts. So then we go through theta decay, its impact on the butterfly, volatility, the importance of volatility crush on the butterfly condor, pricing the option. How does that work? The effects of time and volatility, and then Fibonacci, how I do my price targets using what I call Fibonacci price target mapping and standard deviation. So part of the course has a chapter on this that I'll take you through on to how to make your targets for setting up your trades. And then we go into the actual every combination variation in part two. So what makes them work? So how, why, and when would you use the call, long call, or put butterfly? So everyone is explained in detail with examples. The wide wing butterfly, when would you use that? When would you use and how would you use the broken wing butterfly, a ratio butterfly, broken wing ratio butterfly, iron butterfly, vacation butterfly, long condor? So each variation has gone through with the trade details and very, very detailed to show you how they work and when to use them. So very comprehensive there. And then we go through what are the best time frames to use to capitalize on the butterfly long condor, and what should you use for trading? What stocks, ETFs, indexes, futures, etc. And how do you get those setups where you get maybe a 10-to-1 or higher? So go through how that works, where you put up $1 or put up $10 of risk and make 700, 900% return. How do you profit from what we call volatility crush and theta decay? And then another really fun part of the course, that's something we do every month. We try to look for what we call pinning trades every month. So 12 times a year, we have what we call option expiration trades. So what we typically will use to pin or an expiration where price will go out at expiration is we use a butterfly to do what we call these pinning trades. So pinning, so price target setups we'll use, show you how to do that with target analysis. And then we use typically a butterfly or condor to target where it could go out at expiration, looking at any unusual option activity and Fibonacci levels there that kind of line together. So that's part of the course there. And then we dive into the long condor, another section. So how to trade the long condor spread. These are trades that we can do, calls or puts. They'll give us 100, 200, 300% returns. Again, low capital at risk, positive theta trades. How, why, and when to use the long condor. And then part three is just a full section on hedging itself, just hedging. So what I call the progression of hedging, I take you through, okay, how would you hedge 100 shares of stock? Or how would you hedge a call or put option? How would you hedge a call debit spread or whatever, and take you through the progressions of the hedge. And then how do you use the butterfly and long condor to hedge a core position? And then how to use the butterfly or long condor maybe to defend a vertical credit spread or debit spread if you do those. So, and then you'll step-by-step checklist on when to put them on, how to take them off, execution risk management, and then resources, what exchange traded funds to use, what is assignment risk, expiration risk, auto exercise, and then you get a trading library of 58 pages of different trades, butterflies and long condors that you go back and look at. So very, very detailed, extensive course. Little feedbacks from Alicia. She said, I've never seen anyone explain options like this. Excellent. This is exactly what I've been looking for. Very informative. No one has anything like this. Wish I had found you sooner, but I'm glad I found you now. Thanks again for your time today. And then Pam, excellent class, Larry, as usual. You under promise, over deliver. Wish I'd known how to do these hedging before I lost so much money. So your option bonuses are going to be, again, start trading options today. So beginner's option course here. So comprehensive, easy to follow course and video modules and PowerPoint. Benefits of options versus stocks. How options basic works. Mastering puts versus call. What is option expiration? beginner's option strategy, covered call, and then go through a strategy 2, covered call with protective put. And hey, thank you for that, MSM. Appreciate the feedback and comment. So bonus 2 is the trading club. So you get 30-day trial membership. You can start this whenever you want. So you'll get access to my virtual trading room every day during the week. So it's open at 9:30 to 10:30 a.m. Eastern, Monday through Friday. I do a video newsletter every day after the close. You'll get access to that every night. Trading room video, these are archived. Then we do a live Q&A, usually every Tuesday, live and recorded. So come on in and ask any questions, or I go through trade setups. And then Trader's Educational Vault, a vault of trade ideas or trading education stuff that's free to you, and a 60% discounts on everything on my website, all courses and trading software. So from David, this is the best service ever. Been enjoying daily sessions and making money to increase my retirement account. Seriously consider joining Larry for a truly rewarding education that has real benefits. Thanks, David. So bonus 3, we'll do a follow-up Q&A that's going to be recorded that you'll be invited to. So give you additional support there. But don't forget, you've got the 30-day trial membership, and that's designed to give you more support. So you come in the trading room or Q&As for the next 30 days and ask whatever questions you have, and also see what trades that we're looking at or setting up. And hopefully you'll stay on and join the club. And then bonus 4, how the pros use the Greeks. So this is a trading tutorial on the Greeks. 60-page option guide with videos on delta, gamma, theta, option pricing, market maker secrets, standard deviation, and delta and trade probabilities. And then 15 option strategy guide manifesto. So this goes through and shows you construction of and why to use a back ratio spread, maybe a long vertical ladder spread, the calendar, the diagonal, the strangle, the straddle, a lot of different variation trades there just for more education to you. And then last but not least, my simple and brief option reference guide on the Greek. So you can print this out, put on your desktop. So I think it's a great value for you. $1.97, $197 there. And get started today. And I appreciate you being here. And any questions you have, I'll show you currently what we're looking at. What I'm looking at here is the markets. I think we're going to, we'll start stabilizing a little bit tomorrow and Wednesday because we have the Fed meeting, and then we'll see what happens Thursday, right? But if you look at, we're coming down, it's kind of what I was thinking would happen. We would probably get a bounce off these key supports. So if you look at where we are currently, we're at key support levels, short term or longer term, whatever you want to call it, for all the key stocks and all the key indexes. So here's a weekly long term. So you can see the Russell 2000. That's a 100-period moving average support level there. That's also at 382 retracement level from the March low, Fibonacci level March low to the high here. So that's where I thought we'd probably get some type of little bit of relief rally. And then SPY, very similar. So SPY, very, very similar area of support. And you don't want to be selling short down here. You want to wait for it. Let's see if we get some kind of rebound or bounce. So this is what we call price action support. See all the price action here. And this is also Fibonacci levels going back from the March COVID low. So we've got that has a long way down. See this SPY has potential for a bigger, huger move. But this is the first kind of short-term support. Broke a key long-term trend line that goes back to the March of 2020. So that's broken. So any rally right now to the upside, you want to look to short the market, not like buy the dips like it used to be. And I think we're in a different environment now. And I think it's sell the rally mode until we're proven differently in the Russell. Now, if you also then look at Apple and Microsoft, they kind of hit some key areas and they need to digest this area here. We've got earnings coming up, so that'll be a catalyst that could either hold these levels or make them go to the next step down. But hold on. So you can see Apple 160 is a key support. Initially, this is a price action support. See how it came up here, failed, came up here, then held, okay. Price action support, also the 21 exponential. This is a weekly time frame. So this has to hold 160. If that breaks down after earnings, where Apple's headed down here towards that 140. So that's Apple, and then Microsoft. These are the key components of the markets, basically, the way I look at it. Again, very key support area here, price action support. See that at 280. See how it came down and held. Now this is very important. So if Microsoft can hold 280, earnings coming up tomorrow, consolidate here, then that's a chance to pull the markets back up. So that's key. And those are some of the things that we were seeing that we thought that the markets would kind of hold in here today. And then Amazon, similar. So all the major stocks, if you look at them, they came into key areas of support. All right, so see this price action here, and that's a 50% retracement. This is a big support area for Amazon. You've got, so this is from the March COVID low to the high. You've got the 50% retracement here, which it made it down to, and also the 150-day simple moving average, big, huge support. So we'll find out if it's going to hold, though. Earnings are going to be the catalyst for either holding this area or taking it to the next level down, which is the 200-week moving average here at 2434. So any questions here? Oh yeah, I'll explain to you the debit. Sure, let me back up. So question on where the 10 cents came from. Yeah, let me back up there and I'll show you. It's the cost of the trade. Back up here. Okay, here we go. All right, so if you go through the math here, okay, the 44 put, you paid $2.38. The 42 put, you paid $1.06. Okay, so here you go, 238 and $1.06. And then you brought in a credit, you brought in $1.67 two times. All right, so you take your debit cost minus this credit times 100 to make it into equivalent to share to option contract, and that comes up with $10. Hopefully that math works out right. Let me double check. Yep, that's right. That's all it is. Look at your debit cost minus your credit cost. So the $10 per contract, okay? So see here. Now remember, when you're pricing an option, it'll show it in cents, but that you multiply it times 100 to make it equivalent. So it'd be, if it's 10 cents, if it's 10 cents times 100 to make it equivalent to an option, full option contract or 100 shares, that's $10. Okay, so one option contract is equivalent to 100 shares. So you have to do that conversion. So if you look here at, just take a look at Apple or something. Okay, so for example, here, see the Apple's trading at going out at 160, let's call it, right here. See the cost here, it says $4.15, $4.25. Well, the real cost, that's not going to, that's not going to be $4.25. That's actually going to be $425. So you take, it's times 100. So whatever your strike price option price is. So for example, here, down here, you can see the 177.50 strike is, let's say 15 cents. So 15 cents, but you're going to see that's times 100. So the real value then is $15. Okay. You're welcome. How much daily effort do you need to put in? Well, it can vary. I mean, it depends on the trade structure, but with this long butterfly that we set up, really didn't have to do too much to it because it's wide. The one that I showed you earlier, there's not much really anything you have to do once you set it up, other than hopefully take profit. Okay, so all you have to do, I mean, if you want to adjust the trade to reduce your risk, things like that, we can do it. But if you just want to set the trade up, go away. Sometimes butterflies are called a vacation trade because you just put them on and come back. So if we look at this, literally you could just walk away from the trade. Your risk is $177. Expiration is until this Friday, the 28th. And right now it's up $89. It was up earlier today, $130, $140. But if you didn't want to do anything, you say, okay, I'm putting this on and I'm just going to go away and come back Friday and see where it is. You could do that. So there's not much you really need to do. So question, if you have to select just one or two strategies, which ones would you select? Excuse me. Well, my favorite strategies. I've got basically 5 that I like the most. Okay, so I'll show you what they are. And these are the ones that I use because we can use these strategies to adjust a lot of different things. So first off, I just like debit spreads because we can adjust those to butterflies, condors. So I like debit spreads. I'm not one that likes just to go long calls or puts. I like spreads, so debit spread, okay? Credit spreads, I like the combination of credit spreads with the debit spread, but they're not my favorite. 2, these are not in order, just these are what I like. I like the butterfly. And we can create butterflies with debit spreads and credit spreads. 3, I like the condor, long condor. It's not an iron condor, it's called long condor, so totally different animal. 4, I like what we call a calendar. Fantastic strategy. 5, a combination of the calendar is called the calendar diagonal, one of my big favorites. So these are the ones that we primarily trade and I teach, okay? So not in any order, but these are my favorites. These are because these are all very kind of similar in different aspects. So with the debit spread 1 and then 1A, we could have a credit spread, okay? Credit spread. So when we combine those two together, that can create the butterfly, long condor, and then these, we can create calendars and calendar diagonals. So I think that's, hopefully I didn't leave anything out, but these are my 4 kind of go-to strategies. And they depend on what market conditions we're in, So for example, right now, high volatility, high market uncertainty, low risk. These are the 2 best. When we start bottoming out, which at some point, we will start to bottom out or top out. Let's say in this example, though, currently where we are now, when we start bottoming out, okay, so let's say we come down real hard, right? And we start bottoming out. But bottoming out, though, can take days and weeks to get the market to consolidate enough to be confident that it can finally turn. Now, when we get into a trade situation like this, my favorite go-to strategies typically will be a calendar and a calendar diagonal, because the way they're structured, you can trade these, you'll get paid while you wait for the trade to finally turn the corner and trend, okay? So we're basically going long a long dated option and then short a closer in dated option to take advantage of time decay and volatility decay while we wait it out, and we can stay with the structure. So I'll be doing a webinar this weekend. You might want to make sure if make sure, hopefully you'll take the package today, but also make sure to sign up and join me this weekend, because I'm going to be going over some option selling strategies, and two of the ones that are my other favorites will be in that webinar. So let me give you the link for that too while we're here. Hold on. Let me find that link. Hold on a second. Okay, so this will be this Saturday. And you can always, on my website, powercycletrading.com, I always have listed what's coming up. Okay, so here's the link to it right there. And then if you go to my website, you'll always see what we have coming up. And you can register there for any upcoming events that I have. So here is currently, let's see, go back here to, so here's my website here, powercycletrading.com. And usually it'll have upcoming live events. I'm not sure if we have this posted yet. We don't have it posted yet, but we've got a course that we're doing tomorrow on 7 steps to beat your traditional stock bond portfolio. This is a course, this is a fantastic course that actually my wife will be giving. And this is going to be tomorrow. So you could still, have access to that. You can watch the recording and sign up for it. But then the link I just gave you will be this Saturday. So here you can see the courses right currently here. So you can see that if you go to courses and you go to trading courses, you'll see the butterfly course here is $497. You're going to get it today for $197 with those other. Here's the calendar diagonals. This is one will be coming up soon. Just did an earnings course here just last week. And then here's one, the butterfly long condor course here. So you can see it's $497, and you're going to get that today for, $197 with bonuses. So a lot of great stuff. And then if you look here, my trading software, I've got a lot of trading indicators available for Thinkorswim, TradeStation, eSignal, Wealth Charts, TradingView. So a lot of great, all my directional indicators, how I pick trades, those are all listed there. So a lot of great eBooks here. And articles, just tons of articles here. Forex options, why some options are so expensive, how to take advantage of volatility crush, do stock options exercise early, retirement accounts, is it better to invest or trade? So hopefully, there's a lot of good stuff here just to visit, on my website. And then once you become a member, when you get your login for 30 days, you'll have your member login. You'll log in here, and this will give you access to the trading room and our educational vault, things like that. And if you want to check out past reviews, I've got hundreds of testimonials and reviews here. I've been doing this for a long time, so hopefully I can pass on a few great courses to everybody here. So again, I appreciate everybody being here today, and I think that's pretty much going to do it. But make sure to take advantage of this link here, powercycletrading.com / tongue-tied give. Okay, so let me give it to you one more time, and then I'll say adios. So here you go one last time. Okay. Well, again, thank you very much for having me, David. I think it was a great get together, and look forward to working with a bunch of you guys and gals here in the future. So good luck trading.
All right. Thanks, Larry.